Everyone agrees. Natural disasters are horrible. They destroy property and break families apart. Some people may then be tempted to ask the government to protect them from natural disasters, but government intervention actually makes the problem worse. Here is how it works. When individuals know that someone else will pay for the mistakes they make, it gives them an incentive to act in a riskier way. This economic concept is called moral hazard. Suppose there is a safe land, and then that there is a hazardous land, which is essentially the same as a safe one, but with a much higher average rainfall and several flood-prone rivers. In a free market, insurance companies have to charge premiums that reflect the risk insured. Basically, premium rates in risky zones will be higher than those charged in the average territory, and thus, in our case, flood insurance premiums for hazardous land will be higher than those of safe land. Governments often subsidize flood insurance. For example, in the United States, subsidized premium rates in 2010 were less than half of what they should have been if they were to cover the full risk of loss. Price control of insurance premiums is another type of economic intervention by the government that aggravates the situation. A price ceiling may be established with the intention of giving people fair rates, and so a premium rate above the arbitrary level set by the government will be deemed illegal. Governments then proceed to force insurers to take on risky clients at a controlled price. If a given insurer does not want to go bankrupt, it has no choice but to raise prices charged on the inhabitants of the safe zone in order to cover its costs. Taken together, those two measures create a moral hazard. Indeed, because premium rates are lower in the hazardous land, it becomes more attractive than without government intervention by decreasing the price of living. Because of both government interventions, residents of the safe land pay a portion of the hazardous land's insurance premium, either via their tax dollars or higher premiums, and this means that the residents of the safe land will pay for the damages of the hazardous one in case of a flood. Because the price of insurance is a good indicator of the risk of natural disasters, lower prices may also hide the fact that the residents of the hazardous land take more risk, therefore putting more people in danger. Ad hoc government intervention after the disaster also creates further problems down the road. Even an implicit guarantee that the government will bail an agent out if something turns out wrong creates a moral hazard. As with the previous examples, the consequence is the same. More people and property ends up in harm's way. What's the proper role for government, you ask? It is to get out of the way.